Well, hello and welcome to Halftime Report. I'm Sonia Shenoy and with me is Mangalam Malu and Ekta Batra. Well, things are, you'd have to say, just ho-hum in the market. Not too much in terms of activity. The mid-cap index is trending in the green. The Nifty has recovered from the lows. But all in all, you'd have to say that there's not so much happening. So let's talk about a big headline, which is, of course, the auto sales numbers, right?
The auto sales numbers. So let's go straight then. We have M&M, Sonia, I believe, with us. Reported a strong performance in the September auto sales. They've recorded their highest ever monthly wholesale volumes, up, what, 129% a year.
Absolutely. And you know what? The big thing about M&M, as we know, most of the new products have seen very good sales, right? So we have Vijay Nakra, who's the president automotive sector at M&M, who joins in to discuss their September performance. Mr. Nakra, good morning and thanks for joining in. Total sales for September have gone up 129% year on year. Wanted to understand how much of this is inventory stocking to dealers?
So firstly, thank you for having me on the show, Sonia. As far as the numbers are concerned, firstly, they are record numbers and we're delighted that we've had a great month, highest ever overall number, highest ever SUV performance. To the best of our knowledge, that takes us back to #1 position in SUVs, both by volume and by revenue share. As far as your question on stocking is concerned, just to put it in perspective, recently we had also spoken about the strong booking pipeline that we have, and hence these numbers are supportive of fulfilling that demand. We have over close to 260,000 overall bookings across our product range. The demand is very strong across all categories, whether we talk about last mile mobility, whether we talk about small commercial vehicles, or whether we talk about our SUV portfolio. So this is not from a stocking point of view, but our ability to ramp up to fulfill the demand, the strong demand that has been there for our portfolio of products.
And how much of this you think is due to pent-up demand?
Besides Thar, the XUV 700 and the recently launched Scorpio N, the booking pipeline is extremely strong across all other products. In fact, an interesting fact that I would like to share with you is that while the bookings, the fresh bookings for Scorpio N and XUV 700 both continue to be over 10,000 numbers, the Scorpio Classic, which is the refreshed version of the earlier Scorpio, as you know that the earlier Scorpio and the Classic refreshed Avatar and the Scorpio and both coexist. The Scorpio Classic has got the highest booking in our portfolio last month. Even the recently launched Bolero Max pickup has got record bookings last month. So all in all, it's not about building stock, but the buoyancy, the demand of our products during the festive season.
So what kind of a growth rate do you see in terms of sales now that we're heading in, we've kickstarted the festive season with a bang? What do you see as the way forward?
My personal view is there are some headwinds which seem to be appearing with the increasing interest rates, inflation. We can also see that the agri input costs are at an all-time high. Although having said that, government spends seem to be going well and are at record levels. But at the same time, we've seen that there are certain parts of the country that have been adversely affected by monsoon, especially some parts of north and east. So I think it's going to be a little bit of a mixed bag going forward. But as far as the Mahindra portfolio is concerned, as far as our brands are concerned, we continue to have very strong demand as we go forward into the rest of the financial year.
Okay. Well, sir, you did mention that M&M is now #1 in SUVs, and now by both volume as well as revenue share. What exactly is the market share now in the SUV space, and how much has it risen compared to, say, maybe a year ago?
Look, I think it's a little dynamic, and that's why I quoted both volume and revenue share, because all said and done, supply chain still continues to be a challenge for most players in the auto space. And I think the favorite topic of semiconductors, while everyone's managing the short term, there is a systemic gap between demand and supply, especially for automotive grade semiconductors. So I think so from a volume perspective, we ended September with over 19% market share. But like I said, I think one should look at both revenue and volume, because volume market share seems to, depend on capacities and supply chain. And, and hence we are confident that going forward on revenue market share, we would hold position and, continue to remain in the top league of players when it comes to volume market share.
Take that point, and SUVs are doing well. What is your sense of the trend looking like? I mean, how is it looking like going forward? You did mention some headwinds like rising interest rates and inflation hitting consumption in some pockets. Could you talk a little about that?
I don't think I would want to forecast or give a guidance on that, but. Like I did mention, there are multiple factors that are playing out. And, when we talk about SUVs, I think one good thing about SUVs is, and if you can, you take a look at the last 3 years trend, even when the pandemic started and was at its peak, while the passenger vehicle industry declined in 20 and had marginal growth in 21, the SUV segment of the category continued to grow year on year, even during the pandemic, post-pandemic. And of course, this year it's growing at a strong 40-odd%, and the overall PV industry YTD is about 30%. But the point that I'm trying to make is the share of SUVs as a percentage of PV continues to be well above 50, about 50%. So I think from a demand point of view, I think SUVs will continue to remain strong. So some of these headwinds in that sense, while will impact more the space of small commercial vehicles, and partly passenger cars, I think SUVs to that extent will continue to remain strong.
Okay, SUVs will continue to remain strong. I think the question on everyone's mind is what's the launch pipeline, right, over the next 6 to 12 months from the Mahindra stable, especially in the SUV space. We know about the upcoming EV, but what else?
Sonia, I think we'll leave the 6 to 12 months for later, but we've gone out and spoken about our next launch. Actually, we've done the reveal, and there is a full timeline that we've spoken about. Availability of vehicles for test drive and display at our dealerships, and starting our bookings in January, and deliveries too, which is what I'm talking about, is the EV from our first EV SUV in our portfolio in the recent times that we launched, which is the XUV400. So that's the next vehicle that will be out in the market from our side.
Okay, sure. While the wholesale sales to dealers has been very strong, and we know that, can you help us with the retail sales growth in the month of September? And what's the year-to-date sales growth on the retail end?
I think it wouldn't be right to quote September, because the festive season last year was different from this year. The timing of the festive season, so whether you look at Navratri, Diwali, and we all know that a Shraddh comes in the middle, which is a period where people don't take deliveries. But rather than just quoting a number for September, what I would like to talk about is if I look at cumulative by year to date, and especially even if I talk about the last quarter, if anything, we've not added stock to our channel. And like I said, the booking pipeline is so strong. We are doing our best to reduce the waiting period, but currently, whether you talk about Scorpio Classic, Scorpio N, XUV700, XUV300, Thar, there is a significant waiting for our products.
All right, and what about premiumization? I mean, we do see people upgrading to more expensive vehicles, and even within vehicles, there's premiumization with better safety features, premium tires, etc. Would this lead to higher earnings that you have per vehicle? I mean, what does that mean for your margins?
I think what one needs to keep in mind is, of course, there is a certain price value equation that we have got right with our recent launches, where we pack in a lot for our customers. So And I think that's something that we've got right and we manage well. Over a period of time, we do keep taking our price increases from time to time. We do factor in a balance between commodity prices and costs while we take a price increase. So, I wouldn't want to give a guidance on that, but I think one thing, Sonia, we should keep in mind is that while, people are opting for higher end variants in all the brands, we shouldn't forget that with the higher end comes the complexity of that many more features and that much more impact of components and semiconductors, and not only that, various other components, some of which need to be imported, and the depreciation of the rupee has, so while on one side we are seeing a shift in commodity prices coming down, there is also an impact of how the depreciation of the rupee is kind of balancing that. So I think all these factors need to be seen from time to time, and we do factor in all of that when we talk about pricing, keeping in mind obviously the balancing out on volumes and financials simultaneously.
Okay, well, thanks a lot for that and all the best. That's the word coming in from M&M. Very good set of numbers this time, and number one position in the SUV market now on the back of their recent launches. Let's slip into a quick break. On the other side, Ekta will put focus on a pickup in India's pediatric dermatology segment. More on that in a bit. Welcome back. The market is under a bit of pressure right now, but it has definitely recovered from the lows of trade. The mid-caps have actually moved into the green, and supporting the market today is the pharmaceutical names. So you have Cipla, Divi's, Sun Pharma, Dr. Reddy's, all trading in the green by about 1 to 2.5%. So let's talk about this space. In the latest deal in the Indian pharma market, Torrent Pharma is buying domestic-focused Curatio Pharma. So why is Torrent Pharma shelling out 2,000 crores for a company that's expected to generate around 275 crores of sales in this year? Ekta is here to shed light on the two fast-growing segments that Curatio operates in, dermatology and pediatrics. Ekta.
Well, yes, Torrent Pharma, which will now get 60% of its business from the Indian market versus 50% earlier, is shelling out around 2,000 crores to buy 100% stake in India-focused dermatology company Curatio Pharma. While concerns have been around the deal valuations and the margins, experts say it is an insight into two fast-growing segments in the Indian pharma market of dermatology as well as pediatrics. How is that? Curatio gets over 90% of sales from dermatology, but 60% of the products are from the pediatric dermatology segment. One of Curatio's top-selling products is a pediatric soap, Teddy Bar, which comprises of around 34% of its revenue and generated around 76 crores of sales in FY22. Other top products too are focused on the pediatric dermatology space, such as Nappy Rash Cream before Nappy, Spoo, which is a sulfate-free shampoo, and Atgola, which is a 34 crore brand which is used for pediatric atopic dermatitis. While both dermatology and pediatric segments were impacted by COVID-19, they have seen a bounce back. For example, the baby and child market is currently expected to be valued a little over 12,600 crores, up 14% year-on-year, and is estimated to grow at around 12% and by FY25 reach close to around 18,000 crores. Meanwhile, the dermatology market is currently valued at around 11,000 crores. It can be roughly broken up into two segments, medical and cosmetic. Medical dermatology is focused on more traditional conditions, making up bulk of the dermatology market at around 7,000 odd crores, growing at around 8 to 9%. Meanwhile, the cosmetic dermatology market is mainly focused on skin and hair products for less serious medical conditions, which is valued at around 3,000 crores and is expected to grow 18 to 20% per year. This growth is also reflective in the sales of companies. For example, Curatio sales, which gets around 50% of sales from 3 brands, generated around 224 crores of sales in FY22 and is expected to end FY23 with at least 275 crores of sales. Similarly, Piramal Pharma has a portfolio of baby care brands under the brand Littles, is ranked 5th as a whole in the OTC segment. Other competitors include baby products company, German company Sebamed, which as of 2021 as a whole had grown 5x in the last 3 years, and in a similar category is dermatology company Cetaphil. Lastly, while growth is expected to continue, experts believe there will be continued interest to enter this market via the M&A route, which is already visible. For example, earlier this year, we saw Eris Life shelling out around 650 crores for a Mumbai-based private dermatology company, Oaknet, while JB Chemicals bought 4 of Dr. Reddy's pediatric brands, including a Nappy Rash Cream, for a total of around 100 crores. Experts point out that deals could even be at a premium valuation, as we have seen for Torrent, as they are paying for growing brands in a high-growth segment, which will help outperform the Indian pharma market, with less risk of these portfolios also coming under the price control hammer.
Okay, well, I must say, somebody like me has used Nappy Rash creams for the longest time. Now I know why this business, this industry is growing so much, the pediatric dermatology space. Thanks, Ekta, for that. Aditya Khemka, the fund manager, healthcare portfolio at Incred, joins us now. He tracks the space closely. Aditya, from a listed company point of view, can you tell us who are the beneficiaries?
So, thanks for having me. In terms of the pediatric cosmetology, dermatology portfolio standpoint, I think none of the Indian pharma companies traditionally have a very strong hold in this segment. It's an emerging segment. It's a small segment as it is today, which is why, because it's emerging and it's a small segment today and it's growing really fast, you are seeing some of the inorganic activities that we are seeing around the segment, and that is expected to continue because most of the pharma companies in India basically have come to realize that this is a segment that will grow significantly bigger in a short span of time, and they need to participate in the growth in the segment. So the deal that we are talking about, Torrent and Curatio, is one of the ones that have been announced, and as Ekta pointed out, there have been a couple of deals in the past which are similar. But one would expect more deals to happen around the space simply because it's a space that's growing by leaps and bounds.
Right. So, could you give us some numbers as to the kind of size that it is right now, potentially how big can it be? Any comparisons that you have from global markets, and if you could superimpose that on the Indian framework, will that work? And how do you play this? Do you play this via pharmaceutical listed companies, or do you play this via FMCG companies who are investing in baby care? I mean, offhand, I can remember Dabur wanting to get into this, and ITC having invested in Mother's Sparsh as well.
Yeah, so we don't have data from the outside markets, and it generally doesn't correlate well to the Indian market simply because the price points are extremely different. What we know is, as Ekta pointed out, cosmetology is about a 3,000 crore market in India. Dermatology itself is about 7,000 crores, and they are growing in the mid-teens, largely speaking, in that range. What I do see happening is that we see that more and more companies will get interested in this space, and there are already deals which have happened. There will be more deals that probably will happen, and you will see pediatric market as a segment growing faster. Now, companies that focus on the India market more today are going to be the key beneficiaries. So if you see, our Incred Healthcare portfolio also, we talk a lot about companies focused on branded generics. So Torrent is one company which has done this exercise, and they will obviously benefit over the long term by creating value here. But you also have many other companies that focus on the India segment. And the valuations that these companies are paying tells you, what kind of value these businesses have. And ironically, the listed equities don't trade anywhere close to the valuations of these acquisitions, which tells you the gap between the perception of the private market and the public market in terms of the value of these companies.
Aditya, there were 3 deals which took place within this space, pediatrics/dermatology, in this year. The latest is Torrent, before that Eris Life, and I also pointed out there was this deal with JB Chemicals and Dr. Reddy's picking up 4 of their pediatric brands. Which one do you think was probably the most lucrative from a company perspective, and which of these, amongst these 3 companies, would you probably be more bullish on when it comes to the India portfolio?
So in our Incred Healthcare PMS, we do hold Torrent, we do hold JB, we hold Dr. Reddy's. So we hold all 3 stocks, to be honest. We don't hold Eris Life Sciences. We have our own process investment framework. Having said that, I think the normal way of judging whether a deal will be value accretive or not, people look at the valuations that they have paid as the barometer to judge whether the deal can be accretive or not. But we don't use it at all, because it's not just about what you're paying, it's about what you can do with what you have acquired. And when you look at that, if you look at the history of Torrent, if you look at the history of some of the other companies, I believe Torrent is one of the better companies that do justice to acquisitions, whether you look at Elder, whether you look at what Unicem's brands. So they have been able to do justice to what they acquired in the past. And so has, for example, JB Chemicals, they've been able to do somewhat justice. So therefore, we are more optimistic on these 2, that they can perform better, and we hold both of them in our Incred Healthcare portfolio. Eris, on the other hand, haven't been able to showcase a similar level of execution with their inorganic activity, and therefore we don't hold Eris in our Incred Healthcare portfolio.
All right, we'll leave it at that, Aditya. Thanks a lot for joining in and taking us through the moves that we're seeing in the pharma space, particularly in pediatric dermatology. The market, by the way, is under quite a bit of pressure, so don't lose sight of what's happening with the Bank Nifty. The Bank Nifty has now moved to almost a 460-point cut. The Sensex and the Nifty are both down about 0.6 to 0.7%, and the Nifty has now slipped below that 17,000 mark. So on the other side of the break, we'll get Pritesh Mehta of Yes Securities to give us some trading strategies. Do stay tuned in.
responsibly.
Welcome back. Well, sulking for the markets at this point, and there is an underperformance by the bank Nifty. So a good time to get a technical check-in and how we should approach this weakness. Pritesh Mehta of Yes Securities joins in on the show this afternoon. Pritesh, hi, welcome to the show. You know, a lot of these healthcare stocks, oil and gas stocks are managing to buck the trend today. How would you approach those, and what would your overall strategy be on the Nifty?
Yeah, good afternoon. So, recently we have seen this defensive pack, pharma especially participate in the market. But if you look at the structure of the entire pharma index, since 2015, they have not done anything incredible. They tend to fizzle out soon. So I won't be quite keen of participating in the rally. Yes, there is a possibility of 5 to 6% gains coming in the pharma index even from here on. But if you are having a constructive long-term view, I still believe it is out of space to be in. And when we talk about Nifty, Friday's recovery, is very inconclusive, because if you look at the overall structure of the market, it's still on the downside. It is still stuck in a range of 16,800, 17,300. So I think this range is going to be in the play for next couple of weeks now. But I think within this space or within the index, we can see sector rotation taking place. Several stocks can start participating now. When we look at the heavyweights like Reliance, Bharti, HDFC Bank, they are doing well. So I think that it is going to be sector specific, stock specific now from here on.
Right, so what are those stocks that you're looking at? And since you say that pharma is no more than 5 to 6% in terms of an upside, potential upside, what do you make of stocks that will lead to more gains than the pharmaceutical index if you were to trade any of those?
See, to understand how the index is going to play out next couple of weeks, we have created a customized top 10 index. So it's the index of top 10 Nifty stocks, and basically highly weighted Nifty stocks, which come out around 58-60% of the index weight. So when I put that together, it has recovered from the 50% midpoint of the entire June rally. So I believe that the next leg of upward will be driven by something like Reliance, L&T, HDFC Bank, ICICI Bank. These stocks will be the leaders in the next few weeks.
Okay, all right. Well, thanks a lot for joining in and taking us through your stocks. That's Yes Securities. Let's take a quick break on that note. But before we slip into a break, here's some great news for investors. You can now track US market action real time on Money Control. Log on to the Money Control website or the app and stay informed about all that matters in global markets.
Welcome back. Bharti Airtel is doing well now. It's recovering from the lows, currently at the high point of trade for that stock, up around 1.5%. And then we have Hero MotoCorp as well, recovering from the morning lows, up around 1.6% from the lows. at the high point of trade. So let's talk about individual stocks itself, and I did speak about Hero MotoCorp. So let's go back to Sonia. Sonia, automakers seeing a bit of profit taking, but it was a decent month, right?
It was a good month, and as you said, there's some profit taking because these stocks have rallied a whole lot. So I decided to bucket them into good, bad and decent numbers this time. Let's start with the strong earnings. The best of the lot by far has been Eicher Motors with its Royal Enfield numbers, bumper sales over there. These are the wholesale numbers, so the amount that they sell to the dealers. And over there, 82,000 units is what they sold, which is a 145% year-on-year growth, very strong. Ashok Leyland next up reported very good numbers as well. Highest sales since March of this year. Total sales up 84% on a year-on-year basis. M&M as well was not too far behind. Its recent blockbuster launches have resulted in very strong numbers, record high numbers for them. 64,486 units, which is a growth of 129%. M&M now has the #1 position in the SUV market by revenue and market share, so that's looking very good. SUV sales itself went up 166% year-on-year, and the management told us just a while back that the market share now in the SUV space is 19%. Escorts Kubota as well, very strong growth in September, total tractor sales up by almost 40%, and Tata Motors too, total domestic sales went up 44%, very strong growth in the passenger vehicle sales, although commercial vehicles was a bit of a low single-digit growth. On the weaker side, almost all two-wheelers reported weakness in sales. So Hero Moto total sales were down 2%. Bajaj Auto, quite a bit of weakness in exports over there. Export sales down 33%. And TVS Motor as well. Overall sales growth was 9%, but exports were down about 9.2%. And for Maruti, it was a decent showing, slightly below what Nomura was expecting, but nevertheless a sales growth of 104%. Although both Maruti and M&M have told us that recent headwinds like higher inflation, higher interest rates could perhaps dampen demand in the near future.
Okay, all right, Sonia. So that's on the entire auto sales segment. But ONGC is the other stock in focus. It is managing to gain in trade. In our special segment, Value Add, Sonal is here to tell us the impact on the stock after the government revised up gas prices and windfall tax cuts on crude. Sonal, over to you.
Thank you so much for that. Well, multiple things which are working in favor of ONGC today. The first one, of course, being that gas prices, they have been hiked by 40%. That is for the second half of FY23 to $8.57 per MMBTU. This compares with $6.1 per MMBTU. And this is the highest domestic gas level that we have seen since 2014. That is, since the time APM gas pricing formula came into being. The ceiling for gas from domestic difficult fields is set at $12.50 per MMBTU, up 25%. On the back of which CLSA says that gas price hike to add value worth 35 to 40% of current prices of ONGC and Oil India both. The second one being the decline in windfall taxes that we have seen. Windfall taxes on crude oil production have been cut to 8,000 rupees per ton versus 10,500 rupees per ton earlier. And CLSA says this, of course, is a $5 per barrel cut that we have seen. This compares with $4 per barrel cut that we saw a fortnight ago as well. So there has been a continuous reduction in line with cut in crude prices, which is a positive, and this implies a post-tax realization of $75 per barrel for ONGC, and that is a big positive because right now it is pricing in $40 per barrel as realization. The third is that Brent crude prices, they have surged overnight up around 2.5 to 3%, and this is ahead of the OPEC Plus meet, which is expected on October 5th, and OPEC Plus is considering an output cut of 50,000 to 1 million barrels per day. So that would mean more price hikes for crude oil prices, which is ultimately positive for ONGC. In terms of valuations, as I already said, it is actually factoring in just $40 per barrel as realization. So there is a big upside expected, and it is trading at 4 times FY23 EPS. So valuations are still very reasonable, and that makes a case for upside for the stock.
Okay, well, thanks a lot for that. But MGL is also down in trade quite a bit. Is it because of that tariff increase?
Yes, it is because of that. There has been a new order that has come in for MGL, where the PNGRB has ordered MGL to pay pipeline tariff for the Uran-Trombay line as per the approved rate from January 2014. This has been an ongoing case between ONGC and MGL for a long time. MGL has appealed to different forums, but finally PNGRB has come out with an order, and they say that this is to be cleared in 2 months. Otherwise, they'll have to also pay interest on this particular amount. While the order does not mention a specific specific amount. In their notes to accounts, MGL had earlier said that the contingent liability that they have related to this particular order is around 330 crore rupees. And this total demand is from November 2008 to July 2021. And according to calculation, this implies a 33 rupees per share impact on the stock price as well. And analysts say that recurring impact on the EPS would be around 1.5 to 2 rupees per share. But remember, it is a one-time impact if they show it in their books. However, the company sources are telling me that they will contest the order in higher courts. But seems like since the PNGRB order has come in, the company will have to pay this amount. And that's why, other than the gas price hike, this is also impacting the stock price today.
Take that point. Thanks a lot. MGL is down almost 3% as we speak. But let's stick around with this theme itself. Let's also get in Harsha Upadhyay of Kotak Mahindra AMC's opinion on these gas price hikes. He spoke to us this morning.
Obviously, what has happened over the last 12-18 months in terms of price hikes has been difficult for some of these players to manage. While until now they have managed their margins, broadly taking the consumer prices up. But the recent hike is again going to leave some pain in the short term until they manage their overall cost dynamics. But we do believe that what we have seen in the 12-18 months in terms of gas prices may be behind us, and going forward, very unlikely that you will see this kind of price increases. Probably you can see gas prices peaking out as well. So given that context and the fact that these are near monopolies, we continue to hold a little bit of position in city gas distribution at this point of time.
Okay, well, let's move on to one of the top gainers on the Nifty today. Coal India is the third top gainer on the Nifty at this point. The company recorded growth in its coal production during the April to September period. Nigel is here to give us more statistics. Nigel.
Well, Coal India came out with its September operational update, and in fact, it looked quite good. On the production front, well, they continue to do very, very well. The volumes are up at close to 12%. And offtake front, well, it was up close to around 1% or thereabouts. But for a September quarter, when you do close to 49 million tons odd, it seems the street likes that. Now, year to date, that's for the first 6 months of the year. Production numbers up at close to 20%. You have offtake that's up close to 8%. And the management says that they have achieved more than what they set out to on the offtake front. So close to 102% of what they initially set out to. And on the production front, they say they've already achieved close to 43% of their targeted 700 million tons. And as we know, second half of the year, volumes do pick up. So all in all, it seems a good set of numbers coming in from Coal India.
Okay, a good set of numbers coming in from Coal India. But let's get back to the pharma space. If you just saw, the stock of Zydus Life Sciences was flashing on the screen. It's up 5% right now. Lupine is also buzzing in trade. Ekta, why is that?
Well, I'll start with Lupine, which is in focus because they've received an establishment inspection report, which is an EIR for their Ankleshwar facility, Ankleshwar manufacturing facility. The inspection at the company's facility was conducted from August 16th to 19, 2022. So that basically the EIR, the street is assuming, is going to be an all clear for Lupine for this particular facility, and hence you can see that the stock is higher by around 4%. Now, the other stock in focus is Zydus Life, and remember that Lupine is also reacting to such a piece of news, whereas it is largely normal course of business because Ankleshwar really wasn't under the scanner. The Zydus Life stock is in focus because they've received 2 US FDA approvals for drugs. So the first one, which is probably aiding the stock in terms of sentiment, is that they have received US FDA nod for Mirabegron ER, which is extended release tablets. And the drug is indicated for the treatment of an overactive bladder. The market size is huge. It's $2.42 billion. Lupine received approval last week. Analysts say that it is a confidential settlement date. Base case is a CY23 launch, and it could be competitive with 6 to 7 filers. But what is setting Zydus apart is that they have said that they've got exclusivity, shared exclusivity on this particular drug. Net, what they finally make, how many people are probably going to sell the drug during that 180-day time is something that the street will look out for. And however, whoever I've spoken to has said that it is quite a competitive market in terms of this particular drug. Now, they have also received approval for another drug, sildenafil, which is for oral suspension. It is used to treat high blood pressure in lungs. Market size around $65 million. So the fact that US drug approvals are picking up is positive for them.
All right. Thanks a lot for that, Ekta. With that, we Slip into a short break, and on the other side, we bring you the spotlight on India's credit market in August. A complete explainer on the recent trends. And for the first time in 14 quarters, we actually saw the credit market spend decline in August. What led to that? Abhishek will tell us in our news segment.
Welcome back. Well, now moving on to a deep dive on the credit card market in India. We have Abhishek Kothari, who's joining in with an explainer of all the major trends on spends and market share as well, and what we should probably look forward to.
Well, credit card issuance growth rate for the month of August on a month-on-month basis has declined, and this decline has come for the first time in last 14 months. HDFC Bank continued to gain market share in spends. The reclassification from RBI led to card issuance numbers being down, especially for the likes of HDFC Bank and Axis Bank. Now, credit card issuance on a month-on-month basis has declined for the first time in last 14 months, down about close to 2.8% month-on-month. So, there is an RBI ruling to not classify those cards which are inactive, in terms of 12 months or more. So in total number of cards. Hence, primarily, it looks like it has taken a toll on some of the players. So card issuance on a month-on-month basis was strong for the likes of DBS India, Federal Bank, South Indian Bank, AU Small Finance Bank and IDFC First Bank, while it was weak for the likes of Canara Bank, Axis Bank, SDFC Bank, Bank of America, Bank of India as well as Yes Bank. Overall spends for the industry have declined by 3% month-on-month. Spends per card, however, have declined by just 0.2% month-on-month, and it remains below May average by about close to 2.5 to 2.6%. Let's take a look how the market share in terms of spends have moved over the last 6 months. So in spends, HDFC Bank has gained market share in last 6 months, while SBI Card has arrested the declining trend for the first time in last 6 months. ICICI Bank has lost massive market share over here by almost 228 basis points month-on-month. month. So top 4 have seen their market share in spends decline from 74.5% that they had in April 2022 to right now about 73.3% that they saw in August 2022. Market share loss in spends over the last 6 months is seen for the likes of SBI Cards, ICICI Bank and IndusInd Bank. Highest market share gain in spends over the last 6 months is seen for the likes of HDFC Bank, Kotak Mahindra Bank as well as Bank of Baroda. So market share movement for HDFC Bank, it continues to remain the leader over here with a market share of close to 28-29%. And HDFC Bank has been able to gain massively in terms of market share over the last few months. This followed by Axis Bank as well as Bank of Baroda. However, on a declining trend, we have seen market share loss for the likes of SBI Card, ICICI Bank as well as IndusInd Bank in terms of market share in spends. So the outlook in credit card business is that the decline in average spends, that continues to be a cause of worry, but it can pick up in the coming months owing to the festive season that we will witness. So RBI has also asked banks to reclassify the number of cards and remove the non-active cards or the cards which have not been active for 12 months. This has had its impact on some of the players like HDFC Bank, Canara Bank and Axis Bank. Card issuances can decline for some in the next couple of months due to this RBI diktat. HDFC Bank is gaining massively in spends market share over the last few months. With festive season coming up, we can expect spends for the industry as a whole to increase from current levels.
Take that point, Abhishek. It's the festive season trends that we will have to monitor, but it'll be interesting to see whether, the increased usage of UPI, if that is impacting credit card spends, etc., or not as well. But we'll step into a short break. On the other side, we'll get Manisha Gupta, who will be joined by Kunal Shah, who's the head of commodities and currency at Nirmal Bang Commodities.
Welcome back to Halftime Report and talking about the crude and the metal prices right now. It actually is trading in different directions. If you look at the crude oil prices, we're trading nearly 3% in the positive, and this is ahead of the OPEC and allies meeting. But on the other side, the metal strength clearly has not been able to hold on. Crude on your screen, by the way, now inching 3.25% on the higher side. So this is one place that clearly seems to be rallying. Joining us now is Kunal Shah of Nirmal Bang Commodities. Kunal, highs to the crude oil prices first, because we opened 2.5% on the higher side and now we are nearly 3.5% higher.
We won't like it, but the fact is that oil prices are now going to go up. So unfortunately, at the time when there is so much turmoil taking place, there are concerns about inflation. OPEC Plus, led by Russia, is clearly indicating another 1 million barrels of production cut. They started last month with a 1 lakh barrels of production cut. Now they are talking about a 1 million barrel production cut. This will lead to a major deficit in oil market. Right now, oil market is in a deficit of 0.6 million barrels per day. That deficit will expand to 1.6 million barrels per day with this kind of production cut, and it will not end. So if oil prices goes down further, they are going to do more production cuts. And I think this is mostly going to come from Russia. So it seems that the energies are basically used as a weapon right now. And even in this kind of times, in this so much uncertainty across the world, now the shock to all of us is going to come, where oil prices are going to at least go up by another $8 to $10 in a matter of 1.5 to 2 months. So not a good news for oil bears. I think oil prices are going to go up, and we are going to see a sharp rebound.
All right. So when you say $8 to $10 of a jump up in crude prices in next 2 months, clearly is not good news there. But the point being that 1 million barrels of an output cut is what the markets are thinking about or factoring in right now. If we see something lesser than that, would you say that there could be some profit taking on those levels?
Yeah. So the narrative here, what I said is OPEC is going to cut the production by 1 million barrels. That's the main narrative. So if the narrative changes, if they do not cut 1 million barrels, then obviously you are going to see another decline coming in. But it seems, that OPEC is not happy when oil prices will go below $80. They are not going to like it. They have tested the blood. They have seen oil prices sustaining about $110, $115 for 2 quarters at the start of the year. They want like $80, and Russia obviously right now seems to be in a more dominant position. If Russia, for example, OPEC doesn't agree to cut the production anyway, from 5th of December, European oil embargo is set to take place. So to add the fuel in this war, Russia will deliberately say, okay, look, Saudi Arabia is not going to cut the production. Qatar is not going to cut the production. Iran is not going to cut the production. But I will cut the production by 1 million barrels, because anyway, Europe is not going to buy oil from us from the 5th of December. So I'm expecting this kind of move from Russia, and this will lead to further upside in oil prices. Not a good news.
All right. No, you don't give us good news on crude, clearly. But talk to us about the metal prices. Is there some support coming in there? Because the month of September, the quarter that has gone by, was not positive for many of these metal prices. But now, because of capacity concerns in Europe, also China is opening up, and we've seen a couple of better economic data come in from there. Have you turned a buyer in some of these metals?
This week, China is not, there is a holiday in China, so we are not going to see any major move. But what I'm expecting is the way dollar index have weakened from 115 to 112, some macro-related buying. So because weaker dollars, higher commodity prices, that equation is going to come into play. And we are going to see a bounce in most of these metals. Copper in particular can bounce till 652, 651. Same way, zinc can bounce till 275. But I'm not bullish. The fact is, my narrative is here that metal prices are not going to move up because of the demand concerns, not because of the supply issues. So the global economic growth is going down. So even though China has come up with a stimulus package, but it's not that meaningful right now, considering the state of economy over there. So we can see a bounce in metal prices, but I continue to remain bearish on all of them. And if I was to advise somebody, I would sell the rallies rather than doing this bargain hunting.
All right. So for the current quarter then, until the time we see end of this year, what's your sense on the metal prices? I mean, you've already told us that copper is the most bullish on your screen, relatively on what the narrative that you're working with. What kind of a decline, what is the range that you will work with most of these?
Okay, I'm expecting by the end of December, copper on LME will again go below $7,000, 6,800, 6,850. And from there, you can see some meaningful recovery. Aluminum already down. I'm not expecting a major downfall, another $100 from here. It doesn't have a room from here to go down much. But I think the demand concern will dominate this complex rather than the supply side issue or the lower inventory in the LME warehouse. So I'm expecting another 4 to 5% decline in most of these metals.
Okay, Kunal, Manisha, thanks very much for joining in, taking us through the entire metals basket and what it's doing today. Well, with that, it's also a wrap on Halftime Report Business Lunch just after a short break. Stay tuned.